So, good morning. I'm Justin Barrett. I am the president of the Tribal Leadership Council. As everyone knows, we try to do a monthly webinar. And in August, we wanted to do a market overview. And so joining us today is Bryan. He's the founder and CEO of IndiWealth.
Thank you, Justin. Appreciate it. All right, everybody. We're just going to get going here today. So I hope you can all see my screen. Justin, can we confirm that you can see the
Yes.
presentation? Perfect. All right. So as Justin said, I'm Bryan. I'm from IndiWealth. I'll get into that here in a minute. But today, really, we're going to talk about markets, policy, and planning, and especially what the recent administration changes, some of the adjustments they've been making, how that affects both the markets and how that affects how tribal governments, tribal offices can adjust planning and basically create some resiliency in the face of what is pretty aggressive changes overall. So in advance, I'd like to just apologize. I'm using the PDF version today rather than worry about whether my slides get messed up. So, but from here, so just quickly on IndiWealth. So IndiWealth, really simply, I'm not going to spend a ton of time on us. This is not a commercial about IndiWealth, but we customize investment solutions for tribal offices, foundations, and endowments. And really, it's under a simple premise of our mission is to help achieve yours. We really try to build customized solutions. We try to get involved and know the people and the constituencies that we're working with in order to provide them solutions that fit them. We do not believe in cookie cutter solutions. One size does not fit all. We have to know the mission and we have to know the time frame. And with that, we can build a customized solution that succeeds in achieving the goals of whatever those goals may be. So me personally, I'm Bryan. I'm CFA, a chartered financial analyst. For other people who have had, my relatives have called me CFA in other ways in the past before. I'll let you figure out some of those ones. But that is what actually that stands for. I've been in the industry for over 25 years at this point right now, which every time I say that makes me feel older and older. But really have done investment management for the most part of my career. The last stop I did was I led an investment team at a firm called Gradient Investments, where we managed over $6.5 billion of assets under management. We had 30 different strategies, so I really have experience and really in-depth knowledge and understanding and actual implementation of several different strategies, whether that's cash, whether that's fixed income, whether that's stocks, whether that's alternatives, kind of across that board and across that gamut. We had all strategies because, again, people need different solutions for different people. So we had alternatives for all of them. I've spent most of my career and most of my life, honestly, in Minneapolis area. I grew up right in the heart of the city. Except for a couple of years, I was with a hedge fund out in New York. So I've had alternative investment exposure as well, from active investing in what was called the long short equity strategy in New York. Spent a couple of years doing there. I liked it. My wife hated it. And as usual, and as always under most circumstances, the wife won and we came back to Minneapolis. And honestly, I love it here. I don't mind being here. And it's except for the 6 weeks of winter. 46 weeks of the year, I feel very comfortable living here. For 6 weeks, I feel like I'm a lunatic for living here, but we probably will not go anywhere anytime soon. Basically, real basic, I've been on TV before. That's the stuff on the right is that, up until 6 months ago when I launched IndiWealth, well, actually, it's 4 months ago. 4 months ago, I launched IndiWealth, the firm at Gradient Investments. I was on CNBC, Yahoo Finance, Bloomberg repeatedly. It is something I will do again. Right now, I'm more concentrating on getting the business up and running rather than doing that stuff. But it is actually kind of fun. I got to get a rapport with some of the in-house, the production staff and also some of the on-air talent. And so, yeah, it's a fun thing to do for me. And it also kind of just provides a little bit more of, insight into the markets, and we can provide that going forward. Apologize for that. Let me turn that off. Okay, so let's just actually get right into it now. Sorry about that. I don't know why that's going off so much. One second, I apologize. It's the weirdest thing. Anyway, so things are uncertain. So let's just jump right into it right now, and talk about what we're going to talk about with regard to the markets and the goings on there. Is that things are uncertain at this point right now. So this is from the Federal Reserve of St. Louis, and they provide what's called an economic policy uncertainty index. And really, this goes back to the mid 80s here, this chart. And you can see that, it's kind of an index. So it provides when, hey, there's times of greater uncertainty and there's times of less uncertainty. And it kind of bubbled around for a little bit. You can see that historically it would go into greater uncertainty during times of recession. Those gray bars are times of recession where things got a little more uncertain because we were losing our jobs and all the other stuff that was happening there. Turning to now, which is all the way on the right-hand side, 2025, this economic policy uncertainty index was at its highest level ever. This had to do with in April of 2025, if you all can remember, when President Trump came out with a speech and kind of gave the instance of what the tariffs would look like. And he really did it on a poster board, for lack of a better term, and really had a bunch of countries listed and what their current tariff rate is and what their proposed tariff rate was. And those proposed tariff rates were significantly higher than anyone had anticipated. And really no one could understand the logic or how they derived it. Post, we kind of figured it out for the most part. They never really expressly gave the sentiment on it. But it wasn't, let's just put it this way, it wasn't done with an incredible amount of scientific rigor, but it was very, very different than what people had anticipated and much more aggressive. And so if you remember in April 2025, the markets were near all-time highs in March and fell almost 20% during that period. So again, high levels of uncertainty. You can also see through this chart that we've come down a little bit, but we're still as uncertain now with regard to what's going on in economic policy as almost we've ever been. The only time that's higher than currently was the time during COVID when we all went home and didn't know what we were going to do for work or life anymore. So needless to say, it is an incredibly uncertain time. If you're feeling that it's that way, you are not mistaken. This is absolutely an uncertain time, and we have to understand that things are changing rapidly, dynamically, and aggressively. So I talked about this before a little bit, but the tariff levels. Tariff levels have been primarily the source of economic certainty because this has been the new rationale on how we talk about trade negotiations with literally everyone else, right? Is how much are we going to tariff penalizing you to get you to the table so that you'll make a deal, right? Whatever that deal may be, whether that's a win or a loss. I mean, the current administration views every deal as a win. We'll see how that ends up going, but this is how we've changed the dynamic. And this chart kind of walks us through that. Is if you look at this chart, it goes back to 1900. So we have 125 years of history here. And you can see outside of a period of, the 20s to 30s and probably the mid 40s, I would say, we've generally been on a trend of downward. Using tariffs as a percent of the average tariff rate with other countries has generally been on a downward trajectory. Again, the 30s and 40s were in the depression and then the early part of the recovery of that. But subsequently, we've really kind of reduced that rate overall over a longer period of time because there's been the general economic consensus that tariff levels generally restrict rather than improve trade mechanisms, and having high levels of tariffs usually act more as a tax and an inflation component than it does anything of substantial benefit. We're seeing now that this trend, at least among this current administration, is changing and changing rapidly. So you can see on the right-hand side, all those little arrows that point to us spiking our levels of the average tariff rate that other countries pay to us, or that we honestly pay to ourselves over a longer period of time. It's been brought up aggressively. We're back to areas that are just as high as they have been in the last 125 years. And back in April, again, when he brought out that placard, that was when it spiked at its highest level. So we've come down a little off of that with all the delays in implementation, with all the adjustments, some of the deals that have come across. You know, those kinds of things have made it murkier to understanding. And it goes back to what that economic policy uncertainty comes from, you know, the highest level ever. Is all these adjustments and all these changes and all the discussions about where tariffs are, where they're going to be implemented, and then delaying and then adjusting and all that stuff has really led to we don't know. But what I want to talk about here on the tariff side is just kind of how they act. In our opinion, they act as a tax on imported goods. That's really what it is if somebody sends something over at 100, you have a 20% tariff on it, all of a sudden that $100 thing is $120, right? And so the argument of the administration is that the producer pays that, right? Whether it's China, whether it's Japan, whomever we have these new tariffs with, they pay that. I am less certain of that. In fact, I am skeptical of it. I think a little bit of everybody pays that. The producer certainly wants to sell those goods and wants to keep those relationships active, so they may take a little bit of haircut on their profit and take a little bit of back. The people importing those goods so that they can sell them at a higher price later on may accept a little bit less profitability, but businesses generally don't run by reducing their profitability to zero. So if you got something from a good at $100 and you used to be able to sell it at 120, well, if that thing coming in is now 120, they're not going to keep that price at 120, right? They may eat some of it and say, well, we'll do it 130 rather than 120, but they're not going to take the whole thing because it eradicates their entire profit base. So there will be a component that is passed on to consumers. Now, where we worry about that, why do we worry about that? Why do we talk about it? Is because that could reinvigorate inflation, right? Inflation in 2021 and 2022 got absolutely out of hand. It was honestly no good for anyone. And that level of high 7, 8, 9% inflation rate is no good for anyone. Prices are going too high, too rapidly. It is hard to assess anything when you have that level of high inflation. We have subsequently brought it down to around that 2.5 to 3% rate, which is still higher than the target rate of 2%, but much closer to average than long-term averages, if you will. The worry is that tariffs bring this back and forth, back upward, but we haven't seen it yet. And I'm going to give you a couple of reasons why I don't think we've seen it yet. And the real reason is, one, producers saw this coming to a certain extent, right? Is, you know, when you hear somebody who gets elected who says we're going to start implementing tariffs, get ready for that. You typically prepare for it. You don't just wait for it to happen. So a lot of them pre-ordered as much as they could to take advantage of the lower prices before the tariffs took place. And so that's the inventory we're working off right now. That's the component of, you know, pricing hasn't skyrocketed because the input prices haven't gone up that aggressively yet. That only lasts for so long, and then now we have to kind of figure that out going forward. But here's the other reason that we may never see this go through, is that there are always choices. With regard to tariffs, it's a good that comes in. Okay, so I can do a couple of things. Historically, the only one where we've had to either use the same amount and pay more or use less has been oil and gas, right? Oil and gas prices, I either drive my truck less or I pay more for for the same amount. You know, that's kind of your choice. That's what you're dealing with. Well, when you talk about consumer goods, there's a third option. And that third option is to use something else, change the production, adjust, right? You can adjust to and from, use substitute goods, use other things that maybe aren't as impactful or as affected by the tariff rates that are currently out there now. And that's what my bottom point is the US economy is just too broad and there's too many waves to just say it's pure one cause and effect. Do I believe tariffs increase prices? Absolutely, I think they do. but it's not a perfectly linear option. It's like, oh, this went up, so now inflation, this went up 10%, so inflation is going to go up 10%. It doesn't work perfectly that way. And what I worry about here is that we may never see a spike in inflation, but because prices are higher, the consumer just says, well, I'm just not going to spend as much as I used to. I can't afford it. So I'm going to cut back. And now I'm worried about my job because I don't know what's happening there. And I'm not spending as much at the store. So they're laying people off and that kind of stuff, where we could absolutely not see a spike in inflation, but still have a pretty bad economy as a result of these types of, these tariff levels reaching these kinds of heights. So we just need to be a little bit careful here. Unfortunately, we have little control over what the administration does in this regard, but understand that this will impact prices, but maybe not in a perfectly linear, oh, inflation is going to get out of hand way. So turning to the last one I'll talk about with regard to the current administration is that government programs are certainly at risk. And the people attending this call and frankly, indigenous tribes are much more used to this than maybe the general population is. This isn't something that is completely new to us from the side of government changing and adjusting on the fly and pulling back on the things that they've promised in the past and those kinds of things. It is something we've dealt with for hundreds of years. But there are current programs at risk. I would say that the current adjustment period is more aggressive than maybe we've seen in the last 20 years or so. And this is just a couple of headlines that kind of reflect that is, the EPA terminating a $7 billion solar program right in the middle of it, including $500 million in tribal energy funding, which I know many of the people on this call were looking at that or are actively looking into that and having to adjust as a result of that. Medicaid cutting, put in $880 billion in potential cuts in the context of state budgets. Like, who makes up for that? Do we cut services? Do we adjust? How do we to support what they said they were going to support before? And lastly, grant funding, school budgets, all the other stuff. This is all just a very much combined component in saying that the U.S. government as a source of reliability is certainly less than it was in the past. I would say 20 years. Again, the question is, was it ever an incredibly reliable source? My gut says not that much, but at least you could historically rely on, in the most recent history, on some of the programs getting funded through and those components. That is all up in the air at this point now. So we need to understand that, government programs, basically everything is up in the air, and the decision-making processes to getting them done are going to continue to be negotiated and continue to adjust going forward. Given I said all of that fun stuff, you would think the markets were having a pretty difficult time, and that's not true. Despite this, the markets are having a pretty good year. So if you look at bonds on the left hand, going on the left, these are the different indices, just different asset classes. So bonds are up about 5%. That's a pretty good year for bonds. Large cap stocks, the S&P 500 are up almost 10%. So we're in double-digit territory or near double-digit territory, which is a great year. It's right with the long-term averages. International stocks are having a very strong year. Now, international stocks over the last 10 years have been pretty significant laggards to the U.S., but not so much this year. This year, having a bit of a re-rally here. So international develops up 20%, emerging markets up 18%. And then even alternatives, just quick alternatives I used here was just Bitcoin and gold. So alternative currencies, if you will, are up 18.9% and 28.9%. So really, really strong years across a lot of different asset classes. And starting with bonds, interest rates have been bouncing around, right? Is that, long-term rates, because of all the economic uncertainty, that's what long-term interest rates, like long 10-year treasury rates, 30-year treasury rates, that goes much more towards economic sentiment. And so what you've seen is a lot of bouncing in there. So they'll get up to near 5, and then they'll drop to almost 4, and then they'll come back up. But they've really remained in kind of a tight range to where they're still paying you the income. And so you've generated almost 5% from bonds. The short term, the Fed has not moved in 9 months, I believe now. So short-term interest rates have maintained very steady and just kind of continued to pay you that recurring income that is relatively high at this point right now. So 5% again for bonds, 5% is actually a pretty good year. If we ended the year at 5%, it would still be a pretty good year. Stocks, the biggest thing I always tell people about stocks is stocks are going to follow, if they follow one thing most closely, they follow earnings. In the short term, absolutely not. You can have a very positive earnings year and have a negative stock market. You can have a negative earnings year and have a positive stock market. So it doesn't work on a year-to-year basis. But generally, company earnings, so S&P 500 type of companies, their earnings growth over longer periods of time highly correlates to the return of the stock market. And despite all this uncertainty, despite all the things, earnings have been pretty good this year. We're on track for another double-digit year in earnings growth for the S&P 500. That's a good backdrop for the stock market. What I will tell you is the stock market has also gotten much more expensive here recently because it's been led by these AI-driven companies like NVIDIA, who reports tonight, and a couple of other companies that have really driven the performance this year. But it's not to say that most companies haven't done pretty well this year. There's been obviously some very negative ones. There are every year. But for the most part, the S&P 500 and stocks in general have been very positive on the year because the earnings are still holding, the earnings growth is still holding up. The other component for the international stocks, the Bitcoin and the gold, a lot of that has come from the weaker US dollar. Again, going back to high levels of uncertainty, when you have high levels of uncertainty, usually that's not good for the dollar compared to other currencies out there. So people have been a little bit more worried about what's going on with the dollar. So what have they done as a result of that? They've gone into things that are alternative currencies, your Bitcoins and your gold. Again, be a little careful with regard to that because the volatility of that is aggressive comparatively, but that's what we've seen. And also when US dollar is weak, international stocks tend to do pretty well in that environment as well. And so that's why you've seen outsized performance in those asset classes, as well as that dollar underperformance here recently has led those asset classes to being outperformers. So that is my backdrop of kind of where we are today in a snapshot. I always like doing this is, thanks for the information, but now what? What do we do with it? That's always the component here is that it drives me nuts when I hear people talking about, things that are and don't really give a roadmap for what we should be doing with that information. So that's what I'm going to try to concentrate on going forward. And this is going to be a much broader angle about how do we develop economic resiliency in the face of all of these changes, all of these adjustments, the potential volatility in the markets that are always inherent there. What do we do to build ourselves so that we can be resilient to this stuff going forward? And in the first one, economic resilience is absolutely, I think, the key essential component to this. And really, this came from the Jackson Hole Symposium, which is the Federal Reserve goes to Jackson Hole, Wyoming every year, talks about stuff and really tries to promote something that is impactful to what they think going forward. And they were talking about US economic resilience, but I believe that this is a stronger argument for just general economic resilience, and especially among tribal governments and tribal offices, is that, the critical components here are diversification and human capital. I think those are the components of business that really develop long-term resiliency, right? None of this stuff is going to be a magic elixir in the next 2 to 3 months, right? Diversification might help you out a little bit, might hurt you a little bit. Human capital and infrastructure building, that stuff is long-tailed, right? That is generational by components. But really, to develop resiliency over a longer period of time, those are the key essential elements. And when I talk about diversification, it just really means multiple streams of return, and that promotes resiliency. I'm going to talk a little bit more about diversification in the next slide, but really that's how having multiple avenues and multiple streams of income and multiple streams of return coming in really does promote resiliency, because you're not sinking or swimming with one particular thing. The human capital and infrastructure side, again, I totally understand the capital infusion it requires, the long-term nature of that, the fits and starts that come along with investment in these areas. But in my opinion, it really is what can create sustainability over a longer period of time, is that having that human capital component and having the infrastructure in place so that that human capital can take advantage of that through educational opportunities, through job deployment opportunities. Developing that capital and infrastructure is really what creates the sustainability, because that will create the economic force that then you can diversify revenue streams and promote yourself as resilient. So I think both of those work really well hand in hand. Again, this makes it seem like it's super easy to do, and I understand and totally get that it's not. But from the side of how you develop economic resilience and are less susceptible to the things I just talked about before, that's really how you have to start that process. Now here, C is the interesting part to me, is because, again, I told you this came from the Federal Reserve, and they were talking about Jackson Hole and the US government, and that government policies play a critical role in building economic resilience. Well, I'm going to put a little caveat on that, is that government can play, and I'm going to talk about the US government here first. US government can play a critical role. They can be an assistance factor. They can be helpful in certain regards for developing these things and helping them along the path. But the changing forces, like we just saw before with the economic uncertainty, the tariffs, all the other fun stuff that's creating trade issues and grant issues and all the economic uncertainty and just general uncertainty that we're experiencing, can be incredibly disruptive to those other things that you're trying to build around resilience. So while US government can play a role in that, it can also play a detrimental role in that. And I said, are they reliable now? And, when you talk about tribal governments, were they ever? That's the question you have to kind of assess for yourself. Now, turning this to tribal government, I believe tribal government can absolutely play a critical role in this, especially around human capital and infrastructure, and then into diversification later on down the road. That is an essential argument for building up the economic resilience so that you're less susceptible to outside forces. It takes time, it's hard, there's no question about it. Things have to be done and tough choices have to be made. But developing that over a longer period of time just really does, and especially around human-centric things, really developing your people up and your infrastructure up so that they can build businesses and do the things they do and create their own personal wealth, which then increases the community's wealth, which then promotes resiliency and sustainability. I really do believe in that, and I really do believe that investments has a place within this as a proper deployment of this to create some of that diversification element down the road. So I want to talk about resilience through diversification here, and I apologize for the eye chart on the left-hand side, but it's really, this is an asset performance quilt, and really just shows a bunch of different asset classes and how they perform on a year-to-year basis. And really, the only thing I always want to show here is that, the top average of, this one has been the S&P 500. And you can see many times that red square, the S&P 500, is at the top. There are some times, though, where it's in the middle, where it's closer to the bottom, where it's really had some difficult times, too. And then if you say, well, I don't want, I can't take that risk. I can only be in cash or, fixed income stuff. Well, you'll probably have a greater certainty of return longer period of time, but you're going to forego a lot of really good years that the stock markets and other asset classes can provide. So by building resilience through diversification, really what that does is, I kind of just say it lowers the bumps, right? Is that you're not going to be sink or swimming in one thing. One thing I can tell you from 25 years in this business, and I've had great mentors and great leaders that I've worked with, nobody can predict this on a year-to-year basis where this quilt is going to be. I wish I could. I wish I could tell you I could. I'm not going to do that. What I am going to tell you is that these types of things will happen from time to time, and having diversification, which is shown by the balanced bar here, which is that black line, keeps you kind of in that middle range where you're not sinking or swimming. You're not having a great year and then a horrible year and then a great year and then a horrible year. And really, human nature isn't built for that kind of stuff. So diversification really tries to smooth the ride more than anything else. And on the negative to diversification, what I always tell people, and this, we used to say this to our advisors that we would train all the time, is that diversification is going to mean that you're always going to have something to apologize for. When you're diversified, you're going to have things that aren't working. That's absolutely going to be the case. And you are going to have things that are working extraordinarily well. Human nature wants to say, thing that's working great will continue to work great all the time. Let's put more into thing that is working great and get away from thing that not working. Human nature, fight or flight, absolutely just a component of ourselves. I will tell you, in the investing world, that is probably not what you want to be doing. You probably want to be doing something nearly the exact opposite, which is things run in cycles. And sometimes those cycles can be 6 months, sometimes those cycles can be 2 years, sometimes those cycles can be generational. But from that perspective, you want to have things that when they're working extraordinarily well and everybody's telling you how they're getting rich from the stock market and all of that stuff, that's where your yellow flag wants to be up, and at least your caution signal and saying, okay, these tend to ebb and flow over longer periods of time. And I've made a lot of money from this particular investment here. Maybe it's time to redevelop under something else, whether that's a different investment, whether that's a different economic source, those kinds of things, something that isn't working now that maybe I can catch the next tide on. That's how we tend to think of plans here when we're building asset allocation structures for our tribal governments. What we're saying is, you're more likely to hear us saying we're taking our money down from some of the things that have worked extraordinarily well, and we're adding to some of the things that haven't worked very well, in the hopes that when that ebb and flow happens, we can take advantage of that. That is how investment mentality tends to work best. It doesn't work every time. Sometimes, again, look at the S&P 500 in 23, 24, and this year has been a month, 21, 23, and 24. So 3 of those 4 years, the S&P 500 was the top returner. So everybody was saying during that period of time, why would I own anything else? I can always just own the S&P 500, call it a day, and I'm going to be great. Well, it doesn't work that way all the time. And especially if this went from 2000 to 2009, which unfortunately I couldn't fit on this chart, the S&P 500 was one of the worst asset classes in the world during that period of time. So you have to understand that that's why you want to have multiple sources of return, multiple sources of income, multiple sources of diversification, because that creates greater resilience over time and keeps you in the game. What I always say about when I talk about these kinds of things, when I'm talking about resilience, is we want to focus on goals, no question about it. But we also want to focus on the time to achieve them. I think time is the most underrated component of what our asset allocation structure should look like when we're trying to build economic resiliency. How much time do we have to achieve what we're trying to do? And this chart tries to bring that home just from a perspective of it provides the ranges what happened during different time periods, whether that's 1 year, 5 year, 10 year, or 20 year time periods. So you can see under a 1 year time frame, I'm just going to use stocks as an example, which is the darkest bar there. Stocks from a 1 year perspective could have as high as 60% return in the past or as low as minus 41. So under a year time frame, you could be 60% richer or 40% poorer. That is, if you need that money in a year, that is not where that should be. That is too much uncertainty because, again, people will tell you all the time, well, the market's going to do this, this, and this. They don't know. They don't know on a year time frame what it's going to look like. They're taking an educated guess as to what it looks like, but they don't know, and they have to understand, and you have to respect these ranges. So if you have a short-term time period where you're thinking about, I have near-term expense needs, or I have funding my operations, or I have a project due in the next 6 to 12 months, or something coming up in the next 6 to 12 months, I need to be taking as little risk as possible and generate whatever return I can from that perspective, because I'm going to need that money in less than a year. The nice part right now is that you're generating a decent level of return for even from CDs and short-term, short duration ETFs. I won't get into the weeds and bore you to death on what those are, but they're paying 4, 5, 6%. So you can generate some level of return right now with a very low risk profile. That is very good for savers. And over a longer period of time, that's where we want to be, because a lot of the conversation right now has been, well, let's get interest rates down again and we really spur the economy. It's possible, but also for savers, that means we're going to return less for the risk that we're taking. And it's going to force us out to take risk to get more return. So be careful about what you wish for with regard to lower, as a spender, lower interest rates are great. As a saver, not so great. From a balanced risk perspective, that's your intermediate term. So, look at that 5-year, you start to compress those ranges. So again, the worst 5-year period since, I believe this is over a longer period of time, 1945. So over the 5-year period, stocks, the worst 5-year performance has been -6%. Again, a lot better. Still negative, still have less money than when you started with, but a lot better than -41. And the best 5-year period's been 30%. You're tightening those ranges again down. And the longer you go out, the tighter those ranges are. And that's why for intermediate term projects, like a capital project, or that it's a plan to replenish those short-term expense needs over longer periods of time, you can take a more balanced approach, right? Because if you have 3 to 5 years, your ranges are tighter. You still probably don't want to take the excessive risk over that you would do for your long stuff, but you can take a little bit more risk here and hopefully generate slightly higher return that'll replenish those short-term assets over a longer period. Then beyond that is long-term, that's growth and legacy. That's your higher risk for greater return. Because again, look at the 20-year period. And over a 20-year period, you've never had a negative stock market. In a 10-year period, you have. That was, again, 2000 to 2009, where we had 2 crashes in 10 years. In a 20-year period, it's never been negative. So in any rolling 20-year period, we've never had negative returns in the stock market. So you can use that time to your advantage. Again, saying 20 years, man, that's forever. Yeah, absolutely. But for the components of how you're setting up your time, that may not be that long, right? For individuals, that may be retirement. For institutions, it's for growth and legacy to expand our operations over a longer period of time. You can handle the volatility and risk under those situations because your time frame is significantly longer. And so using time, I think, is incredibly important to understanding how you properly allocate assets over a longer period. Turning quickly to the types of investments, most of you know these. We have cash, CDs, money market, and again, this is going up the risk profile. We have bonds, understanding that each of these have sub-asset classes. Cash is kind of cash, but there are even some things within cash where you can earn some added sources of return. Bonds, you have very conservative bonds, short bonds, you have 30-year bonds, you have high yield bonds. There's a lot of different avenues and a lot of different risks within those. But for the most part, bonds are going to give you less risk than the overall stock market over a longer period of time, and frankly, probably less return over a longer period of time. Then even in stocks, I mean, obviously I talked about US and international before, but then you throw small caps and you can throw technology stocks versus utilities. There's a lot of different types and a lot of different risks that are associated with that asset class. So even within there, even as you go up this spectrum in risk, there's still different tiers of risks within there. So you have to understand that this is the general philosophy of how things work, is that, the higher risk, the higher return over a longer period of time. But you also have to understand that disbursement, I talked about before, the level of high versus the level of low gets wider the further you go out on here. And then in alternatives, you have things like gold, crypto, real estate. I mean, a lot of different things are thrown into the alternative bucket, and I'll talk about that here in a minute. But really, you have to understand that those kinds of things, these are specialized instruments in a lot of ways, and they can be very useful, but there's a degree of understanding because they can be very different. Just broadly saying I'm investing in alternatives is really not a broad solution to what you want to be doing. You want to understand what types of alternatives, what they're there for, and what their return profile and risk profile look like before just diving in and saying, yeah, I'm going to invest 10% in alternatives. But financial plans do often, and honestly, our financial plans almost always involve some of each of these, because again, it's under that time-based management, is that under short periods of time, we're going to use a lot of cash and bonds. We're going to use a ton of that. That's probably going to comprise most, if not all of it, for anything between 0 and 1 year. 1 to 5 years, you can incorporate some stocks. I don't generally incorporate many alternatives in there. There are some that you can incorporate, but that'll have a component of all 4, but under a much lower, more of a balanced risk type of strategy. And then your long-term, your growth in your legacy is going to be comprised of a lot of stocks and alternatives. It's not really going to incorporate a lot of bonds or cash, because again, you want to take advantage of that higher risk and bouncing around over longer periods of time, because that's how you achieve above average returns over a longer period. So again, turning to the alternative investments, 7 types. This isn't perfect, but it's pretty good. So there's private equity, private debt, hedge funds, real estate, commodities. You could throw current alternative cryptocurrencies and alternative currencies in there. Collectibles, to be completely honest, I never use collectibles. Structured products are a very, very interesting animal and can incorporate basically all the others plus a bunch of other stuff. So you have to really understand what you're trying to invest for when you invest in alternatives to develop that resiliency that we talked about before. Why use them? As a potential for higher return, especially for private debt compared to traditional public debt, can be a little bit higher return. You're taking a different level of risk, and you have to understand that. Private equity, venture capital, these kinds of things, those tend to be very long tailed, but can also be very fruitful over a longer period of time, but shouldn't be anywhere near the money you need in the next couple of years. Those tend to have very, very long lockups. Hedge funds, there's 10, 12, 15 different types of strategies that go within hedge funds. Can be relatively safe to ultra aggressive, so you have to know what you own there. Real estate, again, you can invest in real estate in public markets, but you can also invest in alternative private markets. But really, why you're using any of these types of things is the potential for higher return. Again, around other buckets, using other buckets, giving up some liquidity, giving up some, and adding a little bit more risk through that should enhance your returns over time. You should expect higher returns in here because you're giving up the fact that you can't sell this in 2 days, right? Lower correlation to public assets, again, diversifying those. These don't tend to ebb and flow in the same time. Some of them do, some of them don't, but you have to know how that incorporates with your other strategies that you're deploying. And also alternatives as risk hedging can absolutely be a thing, is that, you can use some of these assets to shield you from really substantial market declines or interest rate risks. There are things you can do to hedge risks for your entire portfolio that you can only do within alternatives. So there are use cases, but the things you need to understand are there are liquid and very non-liquid assets in here. There are some things where you cannot get your money back if you ask them. And if you say, hey, here's my $1 million, and I need that in 6 months, they'll be like, no, that's not what we do here. You can maybe get 10% out. You may not be able to get a 10% any out because of a lockup. You need to understand there are both. In alternatives, we have liquid that can be, you can sell and buy as needed, or non-liquid that are subject to lockups. Volatility does not equal risk. What I'm saying there is that the public markets tend to bounce around because they get priced daily, right? Everything is priced in the markets, right? If NVIDIA is coming up today, NVIDIA will be priced in the market this minute, next minute, next minute, this minute. So you're always seeing what that value looks like. Private markets don't work in the same way. They're not marked to market in the same fashion. A lot of this is estimates and things they can combine together. And so the volatility profile, because it doesn't get priced every day, can often look substantially lower than the actual risk it's entailing. I use this in hedge funds because private REITs sometimes say this all the time, is that, oh, our volatility profile is significantly less than if you were to invest in an ETF or a public REIT. And that's true, but it's because of the measurement system. It's not really because the underlying assets are a whole heck of a lot different. It's because the measurement system that they get priced daily versus the private assets get to say, oh, we'll price at the end of the month and we'll use a mark-to-market strategy, and we can, we can put a haircut on this, and they can adjust those numbers. There are rules to adjusting those numbers that they have to abide by, but they're not getting priced by the market on a minute-by-minute and day-to-day basis. So you have to understand that when they say lower volatility, it does not mean lower risk. Last one, and I hope I didn't do this here, but this can be confusing and they can be very expensive. So I always say in alternatives, you gotta know what you own. I think that goes across asset classes. Know what you own. Understand what you own, and have a person or a firm or a group that can help you understand why you own a particular asset. Knowing why you own something and knowing what it's for helps you build resiliency, because then you're not saying, if you said, oh, I needed that money in 6 months, but I had it in the stock market and now I have 40% less, it's like, well, you need to know what you own there, and you need to know why it's in your portfolio. That is something we strive for here at IndiWealth, is just helping people understand what they own and why it's there. Because an educated consumer, an educated constituent, an educated client to us is much more likely to stay with their plan and stay focused on the things that to achieve their goals, rather than being whipped around by the market's forces and what's going on in the government right now. So last one, quickly, I'll use this. How do I build resiliency? As you work your way up. I use this a lot for individuals, but I think it does work for institutions and governments as well. You have to start at cash flow and basic needs, right? In the individual world, I call it kind of check to check. But look at what that lists in there: food, housing, transportation, daily expenses. Are we doing the things that keep us going on a day-to-day basis? Can we fund those operations? If not, that's where we need to start. I love that quote down at the bottom, is start where you are, use what you have, do what you can. It is about starting where you are and understanding where you are and working your way up this ladder to financial safety, building safety nets. Accumulating wealth is starting to grow and diversify into things that provide more income and use your money to make more money over a longer period. Financial freedom is creating that community you want. What is this money designed for? Now that we have it, how do we design it in a way that enhances what we're trying to do for ourselves? And last one is legacy, is how do we sustain this for 7 generations going forward? How do we figure out, how do we set up the things to create resiliency, sustainability, and not only that, but expand over a longer period of time into helping more people that in the things we want to do. So the last is the path forward. I always say is like, here's where you need to kind of start, is assess. Start with assessment. Where are we now? Where do we want to be? And just as importantly, where do we get the money to do so? I completely understand. I've listened to enough. I've talked with a lot of CDFI holders, and I've talked with a lot of tribal leaders, and they're saying, access to capital is still our biggest concern. I totally get that. There needs to be a path to doing that, and I hope that path gets easier as we go forward. I can't promise that, but there are avenues that are trying to make that easier going forward, even as the government is changing plans to make it somewhat more challenging at this point right now. But you really do need to have an honest assessment about where you are and where do you want to be. Then it's the plan. So whether that's the tribal government economic plan about here's where our human capital and infrastructure needs are lacking right now, here's how we deploy it to make that better going forward. And then the investment policy statement is, what investments can we use to build upon what we're trying to do from our overall economic plan? Is how do we structure that mission to the investments that we're going to use? And again, under the proper time frames and understanding short-term, intermediate term, and long-term needs. The diversification strategy, I am a huge proponent and huge believer of it. I think it's an absolute must, is have multiple sources. Again, most people, 99 out of 100, are not going to be able to tell you with any accuracy what is going to happen in the markets for the next year, 2 years, 3 years. But if you have diversified sources of return and diversified streams, you have the ability to create resiliency that allow you to not sink and swim when things get bad. Lastly, is I think a critical aspect is once you plan, you've got to deploy. You've got to do it. And small is fine. Starting somewhere. Again, going back to using what you can. Start where you are. Use what you have. Those are the kinds of things that just get it started. Small is absolutely fine. Small with progression will create long-term resiliency and sustainability. But you do have to monitor that progress. You have to make sure you're still on with the goals that you want, because we all know over time things change, right? Paths change, adjustments change, governments change all the time. But with regard to what we want, that may change over a longer period of time. So are we progressing towards the goals we want right now? And then as we're adjusting those goals, are we adjusting our plan in the proper fashion to accommodate for those changes? And I always say shift strategically and not emotionally. The strategic shifts are, again, under the plan, under the assessment, under the deployment aspect of it. The emotional is, well, everything seems to be going haywire and I'm just going to pull everything into cash. Or, wow, stock market's at all-time highs. My cousin's getting so rich right now. I need to get involved in that and I'm going to buy. Those are emotional decisions. You need to exercise yourself from that. You need to get out of that emotional trigger point decision making and back into a strategic, does this fit for me over a longer period of time? And then secondarily, where that will lead you to is saying, okay, everybody's telling me things are as great as can be right now. Maybe I need to take a little bit aback here and be strategic about deploying the capital in a better circumstance in the future. Secondarily, everybody thinks everything is terrible right now. Nobody likes it. Everybody's telling me they're going broke and all that fun stuff. Well, I've already taken care of my short-term needs and my intermediate-term needs are pretty much largely taken care of. Can I deploy some capital to build long-term legacy and enhance my return over a longer period of time? So that's strategic thinking versus emotional trigger-made decision making. If you can do that, and if you can be successful, again, you will be ahead of most of the path at that point, because that is incredibly hard for most humans to do. So lastly, shameless plug. I went a little longer than I thought, so I'll make this very, very quick. But if you want to keep up to date with the stuff that we're doing here, again, our goal is to clarify, not confuse. I hope this helped in that regard here. You can always follow what we're doing at IndiWealthManagement.com. We also do market insights and YouTube videos. We do a fun video called Stocks and Flicks, where I take a movie quote and I build that into a financial argument or a financial conversation, those kinds of things. If you ever want it delivered to your inbox, you can just go to IndiWealth.substack.com and you can get all of our content delivered right to you. So, Justin, I know that was very long. Do we have any questions or anything out there?
So a few minutes ago, I dropped in the chat, the Q&A chat. If anyone has any questions, they can drop them there. But I want to thank you for your time today, for sure, Jeremy. Thank you for doing this webinar with us. We appreciate it.
You are very welcome, sir. This was great.
We'll give it a couple more minutes for questions.
Sure.
Thank you, Keith. We appreciate that. So, well, all right, everyone, we will let everyone go and get back to your busy day. We wanna say that we appreciate your time this morning for logging in, and thank you again, Jeremy.
Thank you very much. Take care, everybody.
Thanks, guys.